Hello, everybody, and welcome. This is Bennett Tchaikovsky, and we're going to do some more financial statement ratios really before we get to DuPont and the Altman Z-score. We're going to go ahead and take a look at some more interesting ones, and these are really going to probably apply more to technology companies. But my disclaimer and copyright notice is that the information and opinions in this presentation are those of the author only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved and any distribution is strictly prohibited. So we're going to take a look at three other ratios, and these don't really apply to Five Below, but for those that are taking my classes and those who are looking at technology companies, you probably want to take a look at these. So the first one we're going to look at this is something called the R&D intensity ratio. It's measuring the proportion of a company's revenue that is spent on research and development. It can be a key indicator of how much a company invests in innovation, new products, and technology. This ratio is particularly significant for industries like technology, pharmaceuticals, and biotech, where R&D is a critical driver of growth and competitiveness. Now, the first kind of thing is over here is that, does Five Below have R&D? All right, do they have R&D or something where I think they're buying their own stuff. I don't think that if we look at their income statement, if they did have any R&D, it would probably be buried in something in one of these items. However, there are companies where if you're involved in technology, you want to be going through and highlighting, like NVIDIA. So Ryan, you're welcome. So if I'm looking at this for NVIDIA, you see over here my R&D as a percentage of total revenue is roughly about 10%. And, the one thing to kind of remember is that for a company like NVIDIA, one of the things that's going to be in their cash flows is that they've got a lot of stock-based compensation expense. And I'm guessing a lot of this is in their R&D group because of who they're paying in terms of their engineers. But again, this is something to be kind of going through and looking at. Basically for R&D, and it's really going to be a measure of how we are going through and reinvesting in our company if we do have a technology type company. Let's just go ahead and look at maybe some other companies, though, that might also be having some R&D. If we looked at Intel right over here, we should hopefully see that Intel in their income statement, they do in fact have research and development, and their R&D is actually as a percentage of total revenue is significantly higher. This is going to be 3,684 divided by, again, I'm using the quarterly report 12859. And so this is about 28% of what they're basically going through and putting in. And again, you'd want to be looking at this in terms of trends over time. If I looked at a company like Apple, we should hopefully also be seeing some R&D in Apple. Let's just go ahead, and we certainly do. Apple's R&D is 8866. And their total quarterly sales were 66,613,000,000. So Apple's is about 13%. So NVIDIA is a little bit lower than the others. But again, you have to go through and look at it in terms of different. Every company, again, is basically going to be different. So that's something we want to kind of like, again, everybody has their own way of doing things. But of course, we're going to go here and say not applicable, excuse me, for R&D. We're going to say not applicable. There is no R&D at 5. And it doesn't mean it's anything bad. It's just that it's not what 5 below does. And if you do want to see what 5 below, they're basically selling a lot of different stuff. Like this kind of reminded me of like Candy Rush or Candy Crush from like that, what is it, Wreck-It Ralph movie. But if you look at this, like, you're the WoW crew party room. So this is kind of like an upscale Dollar General, and I found out about this store because I thought when my students were telling me about this thing, it sounded like a place where you're going to buy like vodka. I don't know, but it's actually turns out it's a selling of a discount. It's again, like a dollar type of dollar store. They've got items that are, relatively cheaply priced. So again, so R&D at 5. Now the next one over here is goodwill. So goodwill to total assets. And when we look at that for 5 below, if I go to the balance sheet, there is no goodwill. So again, I'm making this way too easy on myself. And this again is going to be not applicable. No goodwill at 5. So again, not applicable. It does not apply. Now, what I do want to share with you, though, is the power of goodwill for certain companies. And I may have done this before on another video, but I always enjoy doing it. It's kind of fun. And the one we're going to do this for is for Meta Platforms. And what I'm going to do is I want to go back in time to let's go back to 2016. And what I'm going to do is I'm going to go ahead and pull up a quarterly report. And let's see if I can find one like. Let me find one that's going to be a little bit later than that. Let's see if I can find one that's post-acquisition. No, it's going to maybe go to 28. Let's see here. It's still too soon. Let's go over here. That's good. Okay. So what I want to do here is just look really quickly at Meta. And I want to look at Meta back in right over here. I want to look at Meta on 6/30/16. And I'm going to look at Goodwill. Oh, I thought I was going to have a cat visit me. I'm glad my wife's not Katie Porter and going to yell at the cat for getting in my shot. If a cat or anybody else comes in to want to come in and take a video with me, I'm more than welcome to do so. Okay, so my goodwill here is 1843. And then my total assets are going to be over here at 55,739,000,000. Okay, so at this point in time, Meta Platforms has made a lot of different acquisitions. And if we look at okay, so right over here, Meta has basically made 11 acquisitions. So if you kind of start looking back over here, though, let's do mergers and acquisitions. So over here, you've got Facebook.com, Parakeet, ConnectU, FriendFeed, Octazen, DiviShot, Friendster for 40 million. Next stop, Chai Labs, Hot Potato. Let's see where we get to Instagram. Instagram was acquired for $1 billion, and that was in 2012. You've got over here, face.com, Atlas Solutions, Parse, WhatsApp was acquired for 19 billion, right? So obviously there's some big Oculus virtual reality. I always think this is Optimus Prime, but this is really where, when you look at this over time, Meta Platforms has made they've made a lot of acquisitions. And so when we look at this, and these are the numbers I want to have you kind of like focus on, right? So here we are with Meta, and this is as of 6/30/16. And also for context, let's go ahead and total liabilities. Let's also put that in there as well. My total liabilities are 5.3 billion. So my equity is going to be 50,383,000,000. Okay. So now what I want to do is that, I've got this stuff here, but I now want to jump to 6/30/25 because we can. So let's go ahead and take a look at the most recent filing as of 6/30/25 for Meta Platforms. And let's just kind of take a look at these numbers here. So the goodwill is around 20,654,000,000. The total assets of Meta are now 294 billion. Their liabilities for Meta are 99.6 billion, 99,674,000,000, which means my equity is roughly about 195 billion. Okay. Now I want you to just kind of think about this, right? And this is in the course of about 10 years, right? So goodwill has gone up by roughly, has increased by roughly about by 15%. But my total assets has gone up by, on a percentage basis, is about 428%. My liabilities have also increased by a pretty dramatic factor, but it's still less than total assets. And then my equity has gone up by roughly 287%. Now, this is where, when you see like, oh, goodwill to total assets here it's like 32% of my balance sheet. Now goodwill to total assets is about 7%. And this is an example of a company that has leveraged its acquisitions, which I can tell you right now is extremely difficult to do. Meta is absolutely the outlier. But when you see these large amounts of goodwill and intangible assets on the books of a company, usually it means that there's going to be some sort of a problem, because it means that you made these acquisitions. Sometimes the acquisitions can be very, very difficult to make it work. If we went ahead and looked at a different company, if I went ahead and looked at over here, if I did say, for example, General Mills, and I look at General Mills, and we look at, and I'm just going to go ahead and basically lump in the goodwill and the intangibles together, because this really results out of acquisition. So this is going to be 15,660. And then I have over here 7,087. I lost my Google Sheet. So if I went back over here to the other, so this is going to be General Mills, goodwill. And then we have goodwill, And then we have other intangibles of 7087. And we have total assets. My total assets for General Mills are going to be roughly $35.15. Okay. Okay. So my total liability is 23,496.7. So it means my equity is going to be around 9.5 billion. Okay. So the first thing you notice over here with General Mills is that if the goodwill were meant to be, if the goodwill would basically be written off, which is, it has to be impaired. And I'm not saying that General Mills' goodwill is going to be impaired. But if it was, that would completely wipe out the equity. Let's go ahead and take a look. And I haven't done this for General Mills, but let's go ahead and try to look maybe at the same pacing of time. We go back over here and take a look at, maybe let's go back a little bit earlier. Try to find we can use this. So over here, let's take a look. So May 29th, 2016. So this is as of, I'm assuming this is the one I just pulled. This is going to be as of 8/24/25. And I'll put these in place. And this will over here for General Mills be 5/29/16. Okay. So we've got goodwill of 8,741. We've got intangible assets of 4538.6. We've got total assets of 21,712. We've got liabilities of 15,559.6. And we've got equity over here of 5307. So again, not sure if these numbers are seven. Missing a redeemable interest. I'll just throw that into equity. There we go. Okay. So when we look at the goodwill and intangibles to total assets, this is 61%, and now it's gone up to basically like 68%. And also, obviously, the dollars have also increased dramatically. So they basically have added on roughly about 70% to their goodwill. Their assets have grown by roughly 11 billion, or you've seen, 52% increase in the asset growth. When you look at liabilities, this has grown by roughly, 51%. And then the equity here, this is also grown by roughly about 54%. So there has been growth as a result of this. But you still have kind of the same concern, which is really like, okay, if we made these, if the goodwill was impaired, what exactly would come about of it? So you need to be, when we look at the goodwill to assets ratio is actually something that's incredibly important, and why I kind of went through here and took the time to show you on video um, why this is so important for us to kind of go through and understand. Just because even though it's not applicable for our companies at Five Below, it can be very applicable for other businesses. So let's go ahead then and wrap this up. Let's go ahead and take a look at PP&E. So again, the goodwill to total assets ratio is attributable goodwill. Higher ratio indicates a significant portion of the company's assets is goodwill, which may raise concerns about the company's reliance on intangible assets rather than their tangible ones. A lower ratio suggests the company's assets are more tangible and less reliant on acquisitions or intangible value. And lastly, we've got the PP&E to total assets, is that this is really representing the portion of the company's total assets tied up in physical, tangible assets like buildings, machinery, and equipment. Ratio is really understanding for how capital intensive a company is, which can vary across industries. So if it's a high, it's going to be like manufacturing, utilities, or construction. So let's go ahead and take a look for Five Below. So my property, plant, and equipment net, which means it's less the accumulated depreciation. So my PP&E net is 1.2 billion, as opposed to right over here, 1.134 billion. And this is basically going over here to my total assets of 4.339 billion. And then this over here is my total assets of 3.8 billion. So in terms of a percentage, it's about 29% of my total assets. And again, is that something that's common for Five and for other retailers? The answer is, well, I would assume for Five Below, because they're building out their different stores or the like, it's something I would assume that they would have. Now, for Five Below, what we'd also may want to kind of go through and take a look at is with Five Below, and again, if I go five, what is that composition of property, plant, and equipment? Okay, so if I look over here, property. Okay, yeah, let's type in equipment. I'm going to go ahead and take a look. I want to go to the 10K because the 10K may give us more information in terms of asset schedules. Okay, so here we go. So the equipment over here of Five Below is really a matter of land. So they've got 30 million of land. They've got furniture of about 630 million, leasehold improvements of 843 million, computers and equipment, and construction in process. So if it's a leasehold improvement, it means that they don't own it, they're leasing their property. And if we look at the leases, and again, this is something for all of you when you record leases, or if I enter into a lease that I think is longer than a year, might even be like, I can't remember what the months are, but you have to essentially gross up your balance sheet, which to me is absolutely insane, but it is what it is. So you see this operating lease assets, this pretty much really references the leases I basically have entered into, which is kind of counteracted with long-term operating lease liabilities. It's just a gross up of the balance sheet. We don't own it, but we have to go through and record it on our books. So thank you, airlines. Okay, so this kind of wraps us up over here to the other ratios. So these are going to both be non-applicable. And then lastly, over here, we've got 29, and then over here, 29. So those are the other ratios. I did spend a little bit more time on the other ones with other examples, because if you're doing something other than the simplistic 5, you're going to have to go through and do some research. Anyways, thank you for watching. Please don't forget to like and subscribe. Thank you for being with me here this evening, and I look forward to seeing you on the next video. Have a great day.